Welcome back. This is actually my fifth video, right? I've been making this for quite some time now, and now I'm actually showing my face. And this is actually my second take because apparently my face is like blocking the view of the Google Sheet, so I need to adjust it, maybe around this much. Anyway, welcome back to another video. This is a video where I'm gonna be talking about diving into questions from the advanced accounting book. And for today's video, I'm gonna be looking at two questions from chapter 5. We're gonna be doing both of these. I have solved the first question, but I haven't done the second question, so I'm just gonna try to do it as I'm recording this video, spontaneous. But to be honest, I have actually read the questions and I've like kind of tried to find the solutions to this, like as in like try to see how I can work on it. But then I'll try to do it as I record as this video goes. Anyway, first question, we're gonna take a look at this question. So Exuma is a subsidiary of Fabian. They have a markup policy of 10%. The beginning balance of Exuma's inventory was 220, and half of this beginning inventory included merchandise purchased from Fabian. Fabian sold merchandise to Exuma for 550. Exuma sold for 40 of these merchandise to third parties. And these are the sales and cost of sales. So we need to find the amount of sales that should appear and the cost of sales that should appear on the consolidated income statement. So, by common sense, if we want to show the sales or cost of sales in the consolidated income statement, means that we should just combine these two. So sales from both and cost of sales from both. But then in this case it's a bit different. There needs to be some adjustments. Some adjustment needs to be made to these numbers because first of all, Exuma has inventory and some of them came from Fabian. Fabian selling their inventory. And another thing is that Exuma has only sold 440 out of 550 of the inventory. So we're going to make adjustments because of that. For the first question, for the sales, again, I combine the sales from both Fabian and Exuma's, but then I eliminate 550 because the thing here is that Fabian sold their inventory for 550 and Exuma sold for 440, but then they still have 110. They're going to be selling at 550 anyway. So what this means is that there are two 550s in this sales, and so the idea here is that one of the 550 needs to be eliminated to prevent double. I think you call it double bookkeeping. So you need to do that because then this 550 is in both the subsidiary and the parent's account. So we need to do that. And so I reduce by 550 and we should get around this much. So for the consolidated sales. Now the idea here is the same for calculating consolidated cost of sales, but then there's a little bit of a difference in which the adjustments are not necessarily just like the 550 adjustments. There's also the realized and unrealized, in which realized we can just kind of ignore it because it's already realized, but then for the unrealized you should actually deduct it. So the idea of unrealized here is that you have let's talk about it from the beginning inventory. So in the beginning they have 220. Exuma has 220, but then half of it is from Fabian. So the difference between 220 and 110 is like 110. And so because they have a markup policy of 10%, you need to kind of find the profit from it, because this number here is the number after profit. So you need to find the number before profit. And so we can kind of reverse calculate it. And here what I did is that I multiplied this by 10 over 110, and the idea here is that by doing so you can kind of reverse calculate to find the profit from this because of the markup policy. And in here I use 10 instead of 10%, but these two kind of means the same thing. And I basically did it the same for the ending inventory, but then the base number is different. It's not the 110 that we get from this, but it's the 110 that we get from subtracting this by this, because during the period Fabian sold 550, but then Exuma only sold 440, so not all of them, and the residual inventory that they still have is like 110. And so within those 110 there should be a 10% profit, because of the markup, but then it should have not been realized yet because they haven't sold it. And so that's the idea. And that's also why in the final calculation of cost of sales, I deduct 10 from the addition of these two. So and before I deduct it by 10,000, I also deduct the 550 because double bookkeeping and all of that. And so you have that consolidated cost of sales of this amount, 2,940,000. And so that's for the first question. For the second question, we're gonna try to actually solve it as we go. So a company, we can acquire 80% of booty, and so we can sold merchandise for 1 million, gross profit of 20%, but then booty sold only 90% to outside parties, third parties, and they report net income 400. Okay, so what we can do first is we can maybe list like the ownership of the pattern, right? So the ownership is like 20%, 20%, like that. And then they have a merchandise sold of 1 million. That's not percent, it's dollar. Wait. 1 million? Right, 1 million. Gross profit percentage, let's put it like that, of 20. So 20%. Oh, my bad. Okay, 20%. And booty only sold 90% of its inventory. So I'm always getting this wrong. My bad, guys. 90%, and they reported a net income of 400. So the logic here is that, and I'm getting it wrong again. Right. So the logic here is that they reported a net income of like 400, but the problem here is that this is like the total net income. This is the number that if they sell all of their inventory already. But the thing here in this case is that they only sold 90%. They haven't sold the rest of the 10%, so there needs to be adjustments. Oh yeah, and by the way, as I'm discussing about that, the requirement is actually to determine the income, so it's the same discussion, and the non-controlling interest, which we can just take from the income, so it's related to the first question. Moving on. And so there needs to be adjustments made by this. So I'm just going to show it to you. If you have merchandise sold of 1 million and a gross profit of 20%, that means that the gross profit from the total merchandise, let's call it like that, from the total merchandise is 20% of that, of 1 million, which is 20%. 200,000. That's what I mean. And so we're gonna use this same logic for adjusting the net income. And so because the booty only sold 90% of it, so then that means that booty only sold around 1 million times 90%. So wait, no, booty only sold around, oh, I'm actually blanking out. Okay, right, so if booty only sell their inventory, their 900 inventory, that means the residual inventory, so like the ending inventory is like 1 million deducted by 900, you get 100. That's the residual inventory. That's what I was looking for. And so from this inventory, there is like a gross profit percentage of 20%. You know, if they sell it, they'll get a gross profit of 20%. That means that the gross profit from residual inventory should be around the 20% of 100, which is 20. And so these 20 is a gross profit, but then it should have not been realized yet because they haven't sell it. So this is unrealized, should have not been realized yet. And so what we need to do with this is that we need to adjust the income by simply deducting the 400 with this. And so that's how you want to work on the first question. As for the second question, the non-controlling interest, again, the definition is if this, in simple terms, if the parent company owns 80%, you know, and they're a controlling company. Why did I write 20%? This is supposed to be 80%, right? So if they own 80%, that means that the non-controlling interest is 20%, you know, because that will make up to 100. That's kind of what it means. So let's just write NCI percent. NCI percent of ownership is like 20%. 0.2, make it percentage. And so the NCI share, NCI share for 2014 is simply 20% of this. And so that'll be the answer. That's basically the answer for number 2. You just take 20% of 380. And I guess that's also it for today's discussion on the questions. Please do let me know if I did anything incorrectly, or if maybe I did something correctly, but then I didn't use the correct way, you know, or I approached the questions from, you know, a different view or understanding that might be incorrect and might be potentially harmful for me in the future. You can tell me in the comments, and yeah, I am honestly, I'm looking forward to it if there's any. But as for now, this is my take on these 2 questions from chapter 5 of the advanced accounting book, the Beams book, you know, this book. And so yeah, I'll see you with the next video on week 6, so maybe with questions from chapter 6. Yes, goodbye.